Welcome, everybody, and thank you for joining us for our presentation today. Retirement Plan Hardship Distributions, presented by Rachel Faye-Smith, partner and chair of our benefits practice here at Murtha, Cullina. My name is Jackie Rowe. I will be helping with logistics here for today's session. Some housekeeping rules. All callers are currently in listen-only mode. If you have questions during the presentation, you can write them in the question box of your webinar toolbar, and we will answer them at the end of the presentation. All of today's participants will receive an email from me after the webinar with a link to the PowerPoint, a link to the presentation, and an attendance certificate for those all-important continuing education credits. It is now with great pleasure that I hand the presentation over to Rachel, who is going to do a quick introduction, and then we will just dive right into the presentation.
Good afternoon, everyone, and thank you very much for taking time out of your busy day to attend our seminar. My name is Rachel Smith. I am a partner here in the Boston office of Murtha, Cullina, and I concentrate my practice in ERISA and employee benefit plans, as well as executive compensation and tax issues. I work frequently with retirement plans, and one of the common areas that we see administrative and operational issues come up when we have clients who sponsor qualified retirement plans is hardship distributions, the way those programs are administered, the way they are monitored, and whether or not our clients are complying with the IRS's rules on how these programs should be operated. And so we thought it would be timely, especially in light of some recent guidance that's come out from the IRS, to do a seminar on retirement plan hardship distributions, giving our clients a little bit of background on how these programs work, what best practices are for operating and administering them, and what the IRS has given us in the way of new guidance and new procedures on how to operate these programs. Please do feel free to send in any questions to the moderators as the presentation goes on, and if you have something that I don't know the answer to off the top of my head, I'm happy to address it and then follow up with you afterwards to get you the answer. Now, along with plan loans, hardship distributions are one of the most common plan features that we see that to give participants a way of accessing their retirement savings prior to their retirement date. Hardship distributions are permitted in any plan that provides for elective deferrals. And when I say plan here, I'm really meaning a qualified retirement plan as opposed to some of the non-qualified deferred compensation plans that you may be familiar with your participants and with your company structures. So they're a feature that we find in 401k plans, in 403b plans, and in 457b plans. It's a means for participants to access their deferrals prior to the time when they would otherwise be eligible to take distributions out of the plan. Hardship distributions are often contrasted with plan loans because plan loans offer the similar feature of giving people early access to their money. It may sound obvious, but plan loans are intended to be temporary, and they're dollars that are repaid to the participant account over the course of an amortization schedule for the loan. As long as a loan conforms with the regulations that pertain to loans under the Internal Revenue Code, there should be no tax on the borrowed funds. So you can take the money out, use it for the reason you took out the loan, pay back your account over a period of time, as long as your amortization schedule and your repayment terms and term of the loan, as long as those all comply with the regulations under Section 72P of the code, then typically you should not have a tax on using those dollars. Hardship distributions, on the other side, are an actual account distribution. So that's not money that goes back into the plan. It's money that the participant takes and is permanently distributed from the plan. And because of that, the hardship distribution is a taxable amount that the company has to report as taxable income to the participant in the year in which the distribution is taken. In most cases, which is to say primarily for participants who take a hardship distribution prior to reaching age 59 and a half, there is also a 10% early distribution penalty. So it's a more serious consideration in many ways whether you're going to take a distribution through a hardship distribution feature versus a loan, because in addition to having that money currently taxed to you, you're going to take an early distribution penalty, and the money has come out of the plan early and so is not having the benefit of staying in that tax-preferred arrangement and earning money over the life of the retirement savings program. I wanted to talk a little bit about the permitted uses for hardship distributions versus plan loans. Plan loan money can generally be used for any purpose. There are some limitations on loans that are permitted for the purchase of a primary residence. If you specify that it's being used for a primary residence purchase, you can amortize the loan over 10 years instead of over a period of 5 years. But other than that, loans can be used for anything. We wouldn't necessarily encourage it, but if you wanted to buy a fancy new car or a designer poodle or some such thing, you can take plan loan money and use it for that purpose. With hardship distributions, on the other hand, they have to be for an emergency purpose. Now, plans aren't required to offer either loans or hardship distributions, but if they do, it's important to be familiar with the way these features work in plans, and to be comfortable administering your plan, your retirement plan, in a way that that doesn't run afoul of the rules. Now, some of you might be familiar from context of administering your own retirement plans with the difficulties that can arise when these programs are not operated properly. The IRS and the Department of Labor have a policy goal to encourage companies, employers, to sponsor and offer retirement plans for their employee workforce and for participants. But they want that money to be used primarily for retirement. They don't want that money, those accounts, to be used as a bank account for participants when they run into difficulty or have reason to want to access the money. And so they do allow these features. They do not require plans to offer loans or hardship distributions. And when you do offer those features in your plans, it's important to be familiar with and to follow the IRS regulations very, very closely, because if you don't, you'll end up with a situation where you have to do a plan correction, and corrections, for those of you who are familiar with that space, can be quite time-consuming, can be costly, and are a giant administrative headache. And so it's important to make sure you understand how these programs are supposed to be run. So when one of your participants comes to you and asks you for a hardship distribution, there are certain questions that it's important for you to ask. The first is, does your plan document allow for the type of hardship distribution that's being requested? We'll go into some of the specifics on the types of permitted uses for hardship distributions. But the key takeaway for you when you're asking this question is not, does that sound like a hardship, but it's instead, does my plan permit that type of use for a hardship distribution? And it's always going back to the plan document and going back to the summary plan description to make sure that your plan actually allows the money to be used for that purpose. Because these are discretionary features in 401k and 403b plans, 457b, you're not required to permit hardship distributions for all of the common features. And so it's very important to make sure that you know what your specific plan document says. Another question is, does the participant understand the income tax consequences of his or her choice? Now we'll get into detail a little bit down the line in this presentation on what kind of communication it might be a best practice with participants when they're contemplating taking a hardship distribution. But really, because when you take a hardship distribution, that money is permanently distributed from the plan, there is likely to be a 10% early distribution penalty if that age limit hasn't been attained yet, that age 59 and a half. And they're taking immediate income taxation on those dollars, and the dollars are not being permitted to grow in the tax-free environment of the plan for the period when after you've taken the money out, it really is important to make sure that the participant, understands what he or she is doing and really does believe that this is, a necessary course of action. And this ties into the next comment, which is, does the participant understand the impact on future retirement savings? Because it's not just that the money is currently taxed and that early distribution penalty may apply, but it's also that the participant is losing compound earnings over the life of the remaining retirement savings period, which can have a significant impact on their ability to accumulate retirement savings. So let's get into the requirements a little bit on what's necessary in order to permit a hardship distribution. A withdrawal for a hardship distribution has to be for an immediate and heavy financial need and limited to the amount necessary to satisfy that need. So when you're taking money for a hardship purpose, it has to be to satisfy an emergency purpose. The language from the code and regulations is immediate and heavy financial need, and you can't take more than the amount necessary to reasonably satisfy the emergency purpose. So if you need $5,000 for medical expenses, the amount that you take in the hardship distribution is limited to $5,000, plus you can take out an amount of money to cover the income tax that would apply to that distribution. As we alluded to earlier, the plan has to specify the types of immediate and heavy financial needs that are permitted as distributable events in the plan document, and for that you can look at either your specific plan document or your summary plan description. It should be in both. And while it is possible to have what we call a non-safe harbor hardship distribution threshold or hardship distribution program, the majority of plans that I see use a safe harbor. So if you want, as a plan administrator or plan sponsor, to be in a position where you are figuring out whether the specific issue that the participant is facing qualifies as an immediate and heavy financial need, you can, but the vast majority of plan sponsors would rather use one of the safe harbor reasons that the IRS has permitted in the regulations that pertain to hardship distributions. And so the safe harbor, meaning the ones that will automatically be deemed to be an immediate and heavy financial need, include medical care, the purchase of a principal residence, tuition and related educational expenses, which can include room and board at university, payments to prevent eviction or foreclosure, burial or funeral expenses, certain expenses to repair damage to a principal residence, and financial needs related to a natural disaster. For example, we saw a lot of news coverage after Hurricane Sandy about the IRS's relaxing of the hardship distribution rules to allow people whose homes have been damaged by the hurricane to access retirement funds to repair their homes, and they mitigated some of the damages or some of the penalties that otherwise would have applied. And they do from time to time the IRS does from time to time take that kind of action when a natural disaster has been federally declared. The distribution doesn't have to be for the participant, him or herself. It can be, and typically is, in the plan document available for the needs of the participant, his or her spouse, dependents, children, and beneficiaries, which is to say beneficiaries who are not children or a spouse, a niece, a nephew, your beloved next-door neighbor, as long as your plan document is written that way. Since the Supreme Court decision, Obergefell, I always have trouble pronouncing that name, Obergefell versus Hodges, plan hardship distributions also need to include lawfully married same-sex spouses. Now, this, I suppose, is why those of you who decided to join us today were interested in attending, because as you're administering these programs, it's very important to understand in the role of plan sponsor what your responsibilities are to make sure that these programs are properly operated. The plan sponsor is required to determine that the amount is necessary to satisfy the financial need and that the participant can't get the money from another source. And we're going to get into a little bit how you do that. In the case of determining that the amount is necessary to satisfy the need and that you can't get it from another source, that the participant can't get it from another source, the plan sponsor in this case is entitled to rely on a participant's written statement that the need can't be relieved through other sources like insurance, through liquidation of personal assets, through salary, regular pay, or through distributions from other benefit plans, plan loans, or commercial loans. In other words, if the participant says, I really don't have any other money, and I'm willing to write, to submit a written statement to that effect, you as plan sponsor are entitled to rely on that statement. However, you may have heard of this concept of self-certification. The IRS no longer accepts self-certification to document the nature of the hardship. In other words, the participant can come to you and say, I need the money to prevent eviction from my principal residence, and I don't have any other money, I don't have access to any other money to pay. You can take their word for it on the I don't have any other money, as long as you get a written statement to that effect. But you can no longer rely on them self-certifying that it is in fact for preventing eviction from a primary residence. In other words, you can't just take their word for it. You need to see some documentation. Now, the IRS came out with that statement back in 2015 through one of their employee benefit news bulletins. And the community, you may have heard ripples of this through your record keeper or through other avenues. The community of people who work in this space really were surprised when the IRS said this, because it put a real burden on the plan sponsor and the record keeper to ask for documentation to prove that the use is in fact legitimate, and that created quite a bit of consternation. Because of that, the IRS opened up a comment period to permit practitioners and people in the industry to write in on the ways that that participants are able to certify the reason for the hardship distribution, the reason for the need of the hardship distribution. And in the past couple of months, we've seen the IRS coming out with additional information on how to administer programs in that context, which is the reason that I thought this would be a topical presentation to give our clients access to some of that additional information. So an amount is deemed to satisfy the immediate and heavy financial needs safe harbor, so going back to that safe harbor distribution threshold, if the distribution isn't greater than the amount of the need, including taxes, and the participant has obtained all other distributions and loans from other employer plans. And then this one is important, that elective deferrals in the plan are restricted for a period of 6 months after you take the distribution. So the IRS is thinking on that one is, if you're taking a hardship distribution from the plan, it has to really mean that you don't have excess money, which means that you shouldn't have enough money to be putting into the retirement plan for a period of time after you've taken the hardship distribution. That means that when you're educating people about the impact of a hardship distribution, part of the communication is not only is the money you're taking out not going to be available to grow in the plan until your retirement date, but also you're going to be prevented or prohibited from making making additional deferrals for 6 months afterwards. So you're penalizing yourself for that period as well. Now, I do understand, as I'm sure you do, that when people are coming to the plan for hardship distributions, they're not thinking about penalizing themselves, they're thinking about alleviating a dire financial situation, and we do acknowledge that, but it is an important decision relative to a participant's retirement savings goals. So when you're determining that the need is legitimate, it's incumbent upon the plan sponsor to have objective and non-discriminatory standards. In other words, you can't certify a need or acknowledge an immediate and dire financial need for your friend down the hall using a lower threshold than the one you would use for the person you don't like from accounting on the third floor, or whoever that situation applies to. It has to be uniform, and it has to apply to all participants in the same way across the board. The plan document should specify the required information to demonstrate the hardship. We don't always see that level of detail in plan documents, but it's best practice to have it there. If you don't have it in the plan documents, you want to be working with your record keeper to see what information they're requiring, and it's also a good idea to have a standalone, separate hardship distribution policy or best practices guideline as a resource for the people on the ground within your organization to review as they're approving these requests. And then this was especially important because the IRS has made a lot of noise about looking for this. If you ever find yourself being audited by the IRS, one of the things that they are very likely to ask for is a record of all of your hardship distributions and the information that you have taken from the participant to ensure that the program isn't being abused. And so it's important as you administer these programs to make sure that you're keeping the records, you're keeping them for a long enough period that if you ever get audited, you're going to be able to go to that drawer, provide that information to the IRS, and give them good answers. So now let's talk a little bit about the recent guidance. We've had a couple of notices from the IRS over the past few months, one in December, one in February, another in April, that issued guidance on the records that a plan sponsor is required to retain, and that can be in either paper or in electronic format, and it includes documentation of the hardship request, the review, and the approval. And I'm going to pause and just remind you that this slideshow is going to be available to you. It will be mailed to you after the presentation is over. And so if you are taking notes, this is, you don't need to. This is going to be in your inboxes shortly, but this is the list of things you should be looking for. So documentation of the request, the review, and the approval. Financial information and documentation that substantiates the employee's immediate and heavy financial need. Documentation to support that the hardship distribution was properly made according to applicable plan provisions in the Internal Revenue Code. So that's that key point of going back to your plan and making sure that you understand what it says, and also that your program is being operated in compliance with the code and the regulations. Proof that the actual distribution is made, so showing evidence that the money was distributed from the plan, and the related tax reporting, the 1099-R, that needs to be issued when there's a distribution from a retirement plan, qualified retirement plan. And then going back to that point I made to the effect that the IRS is no longer requiring self-certification. So it used to be that, say, you're using Fidelity or TIAA-CREF or Wells Fargo, pick a record keeper. It used to be that when a participant was looking to take a hardship distribution, they could log on to their participant portal, apply for a hardship distribution, say, here's the amount of money I need, so here's the amount I'm requiring to be distributed to me, and here is the reason why, medical expenses, eviction, pick one of the safe harbor or non-safe harbor reasons. And that self-certification, that act of going in and affirmatively clicking on the portal, was enough. And then in 2015, the IRS came out and publicly said they thought that self-certification process was being abused, and they wanted plan sponsors to start asking for more documentation. And so what people started doing was actually asking for source documents, requiring the letter of eviction, requiring copies of the tuition payment invoices, requiring copies of the lease for education expenses, requiring the medical bills, which is something that many plan sponsors didn't want to be or should not have been in a position of seeing for privacy reasons. And so when the IRS came out with this additional guidance earlier in the year, they issued a memorandum that basically said that you can take summaries of those documents instead of the actual physical copies. And that was very welcome guidance to the industry. And this is, I'm going to give you a list of the types of documents that, or the types of summary information that the IRS is considering to be adequate. In order to use the summary documentation methodology, sponsors are supposed to provide a notice to the participant that the recipient of the money agrees to preserve the source documents, so you have to hold on to the originals even if you're just giving us a summary, and make them available at any time on request to the employer or administrator. So we'll just give you a summary, but we promise ourselves to hold on to the records so that it can be proven down the road if anybody looks into this. And the plan sponsor is also required to get the participant's name, the total cost of the event causing the hardship, the amount of hardship distribution requested, and a certification by the participant that the information provided is true and is accurate. And now I'm going to go into some of the specific types of summary information that are required. And this, again, is going back to that safe harbor list of distribution of reasons for requests for hardship distributions. So for a hardship relating to medical care, the plan sponsor is required to request information on who incurred the medical expense, the relationship to the participant of that individual, father, husband, child, uncle, the purpose of the medical care, the name and address of the service provider, and the amount of medical expenses not covered by insurance. For hardships relating to the purchase of a principal residence, they want you to find out confirm that the residence is the participant's principal residence, the address and purchase price, the types of costs and expenses that would be covered, the information about the lender, the date of the purchase or sales agreement, and the expected date of the closing on the purchase. Regarding education, we want to know who the education payments are for, the relationship of the payments to the participant, the name and address of the educational institution, the categories of educational payments involved, and I think that that's intended to include tuition, room and board, transportation. To be honest, I say that, I'm not sure transportation is covered. And the period covered by the educational payments. And I hope what you're seeing here as you're seeing me scroll through these is that it's a lot easier to get a summary of this on a page or in an email or a document from the participant than to actually get the tuition payment, the tuition invoices, and something proving the relationship of the student to the plan participant, the period of the courses, that kind of thing. It's really cutting down on the amount of documentation that needs to be provided to the plan sponsor. For hardships relating to foreclosure or eviction from a principal residence, we want information on, we want to make sure it's for the participant's principal residence, what the issue is and what the address is. So is it foreclosure or eviction, and what's the address? The name and address of the party that issued the foreclosure or eviction notice, the bank, likely. The date of the notice or foreclosure, of the notice of foreclosure or eviction, and the due date of the payment to avoid the foreclosure or the eviction. For funeral and burial expenses, they want you to ask for the name of the deceased, the relationship of the deceased to the participant, the date of the death, and the name and address of the service provider, in this case, probably the funeral home, crematorium, etc. For damages relating to a principal residence, we want to make sure, again, that it's the principal residence, the address, the cause of the casualty loss, floods, fire, meteorite, and the repairs, including the dates of the repairs. So this one gets a little tricky because they might be asking you for money up front, and you'd have to weigh getting the date of the repair. If the repair hasn't been scheduled yet, the money's needed up front. And so conclusions. I think the real takeaway here is that the plan sponsor needs to be familiar with the plan terms. And what I like to recommend to my clients is that they have a checklist of the steps required to approve a hardship distribution. Now, most companies that I work with, have a relative level of sophistication when it comes to approving these types of programs, but it still is more uncommon than I would like it to be for plan sponsors to be operating these plans without, a best practices guideline that they have for use internally. And so, we are happy to help you put one of those together. The IRS information on what's acceptable for the summary documentation in lieu of self-certification is very easy to find if you Google it, or if you would like a copy, you're welcome to email me, and I can send you one that gives you a bit more detailed information on all the types of documentation and information you're supposed to be asking for. But the real takeaway is take these programs seriously. Make sure that you're educating your participants about the impact of making use of the program, and then I really encourage you to put a best practices guideline together. Feel free to contact us offline if you have any questions. And I don't know if we had any. I was told I had half an hour to talk through the presentation, and then if people had questions, we'd give half an hour to answer those. And I'm either pleased to report or horrified to report that there are no questions, which must mean that that was as clear as clear could be. We'll give it a minute or two more. Oh, are we required to withhold on hardship distributions? We got a question from one of the participants. I believe you are, yes. So you've heard me say before that I have a trust but verify approach, and I would actually want to check on the withholding. I do have your name to the participant who just submitted that question. Let me get back to you for sure, but I believe the answer is yes. Going once, going twice on additional questions? Here we go. Is there a limit on how many hardship distributions a participant can take? Yes, there is. It's most likely in your plan document what your particular plan permits. One of the audit issues that the IRS focuses on when they come in and look at hardship distributions is how many hardship distributions are being permitted from a plan and how many hardship distributions are being permitted per participant. And again, the reasoning for that is that they don't want these retirement savings to be used as a bank account. And so I would say on that, your first line of defense is going to your plan document and seeing what it says, and it's very likely that you'll find the specific answer for your plan in that document. Okay, another question, HIPAA and medical care. Do we need to worry about violating any HIPAA rules? So the question there is, when you're getting information about a participant's expenses associated with medical care, do you need to make sure that you're not violating the HIPAA privacy rules that may apply to that disclosure? And the answer is yes, you do need to make sure of that. HIPAA, for those of you who aren't aware, is the federal body of law that regulates the disclosure and use of personally identifiable health information. Anytime you're getting access to medical records about your employees, you want to make sure that those documents are being treated in a HIPAA-compliant fashion, and that they're only being accessed by people who have had the proper HIPAA training and understand the permitted uses of that information. You need to be very careful with HIPAA, and so to the extent that you're getting access to those types of documents, I would say HIPAA training and or a review of your HIPAA practices and procedures would be recommended. It's a very good idea to do that. I have another question. Can you take a hardship distribution for funeral expenses for a parent, or is that specific to your plan? It is specific to your plan, so you will want to check. To the extent to which that's permissible under your plan document, but typically I would say yes. You can take. I've certainly seen it being permitted in plan documents, but it's really going to depend on what your specific plan document says. And I think that's it for questions. If anybody thinks of any additional questions, my email is on the front of the presentation, and I am very happy to answer them for you. It's been my pleasure to be here with you today. Thank you very much for taking time on certainly here, a rainy and cold Friday afternoon to listen to this presentation, and I look forward to connecting with any and all of you down the road if anything else comes up. Okay? With that, we'll sign off. Thanks very much.